Welcome to Nasdaq Trade Talks. I'm Joe Malandrino, Global Markets Reporter at Nasdaq. Joining me at the market site in Times Square, New York City, we have Richard Keary. He is the founder of Global ETF Advisors. He also started the listings business for ETFs at Nasdaq. We're going to take a look at ETF market structure, how strong it's performing in light of the coronavirus. Richard, it's great to have you with us at Market Site. Thanks for joining me. It's also nice to get a positive story out of the coronavirus, and really it's highlighting the strength of the ETF market and the overall market structure, which is a positive thing.
Correct, and there's been a lot written about the negative side. People always think that ETFs are the problem in the markets. And what we saw over the last several trading sessions is that's not the case. We've had huge market swings up and down, and everything worked well, not just on the ETF side, but also on the exchange side. Exchange technology and the exchange structure worked very well. We had no trade interruptions, no stocks were held, everything, worked as it's supposed to work, and it was great for investors.
Well, it also gives investors access to the markets in time of distress, such as this.
Yeah, the ETFs were designed for that, right? Mm-hmm. And there's a misconception about them. That's all they are. Is they're an access vehicle for the market. They reflect what's going on in the market. They don't create what's going on in the market.
Right. Well, you also mitigate some of that concentration risk as well.
Correct. You have concentration risk that you mitigate, and also since ETFs trade throughout the entire trading day, they actually dampen volatility. So mutual funds, as an example, trade once a day at the end of the day. So you have all this volatility at the end of the day as everybody's scrambling to get their mutual fund trades in, all the portfolio managers. ETFs is across the day, so it dampens volatility.
Why do they have the reputation of being disruptive to the market?
I think it's any new technology, any disruptive technology that comes into the marketplace always has its detractors, right? And that's healthy, right? You want that. It helps the industry to hear those things to make sure that we're doing everything properly.
Right, and I also love that you point out here the coronavirus could potentially put out new innovative products.
Yes, and we've seen that in all sorts of market disruptions, right? And obviously there's a human element to what's happening with the coronavirus, and that's the most important part. But from a business perspective, yeah, we're going to see new products. We're going to be working from home more. So there's going to be we're going to change the way we interact with our workplace and the way we act as consumers. So different companies are going to be the winners and the losers, and you're going to see new ETFs form to take advantage of this new economic paradigm that's going to happen after the virus.
You had mentioned that through disruptions before. You've seen it with online retailers, how they've had to adjust brick and mortar and readjust their business models. Cybersecurity is another great example.
Yeah, and that happened. That was interesting because those funds came out right after Sony was hacked.
Right.
And that was in response to that particular event.
Right, and then of course you have the development of all the new technologies that are available.
All new technologies, right? I think blockchain is probably the most popular, and cryptocurrencies. That's been a big focus. We're trying to get them more into the ETF space. So there's a lot of work on the regulatory side for those. Yep. But yeah, more innovation that comes from these.
Well,
events.
while we have you here, what do you think regulation is going to look like? Finally getting a cryptocurrency ETF to the U.S. market.
It's a real challenge.
Right.
It's a real challenge. The issue is from an exchange perspective, from a listing and monitoring, you can't monitor the crypto exchange. You don't know who's buying and selling, so you can't track a trade back to its origin to know if it's a good trade or a bad trade, and that puts the investor at risk. And you're not going to accept any product that's going to put investors at risk.
Yeah.
So
there's
until there's
a lot
surveillance,
of work to do.
regulatory surveillance of that marketplace, you're not going to see a product.
All right, Richard, great to have you with us at Market Site. Thanks for joining us.
Appreciate it. Thanks for having me.
And thank you for joining me on Trade Talks. I'm Joe Malandrino, Global Markets Reporter at Nasdaq.